Hello everyone and welcome to our Proactive Tax Planning for the Secure Act workshop. This is part 3 of our 3-part tax planning workshop video series. Before I begin, I find it is always important to review that there are 5 key areas of financial planning. These areas are preservation planning, retirement planning, tax planning, estate planning, and investment planning. Today's presentation is about the Secure Act. This affects retirement planning, tax planning, and estate planning. However, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. The Setting Up Every Community for Retirement Enhancement Act of 2019, or Secure Act, is one of the largest assortments of retirement plan reforms. The Secure Act had numerous provisions intended to make it easier for businesses to offer retirement plans and for individuals to save for retirement. It also made significant changes impacting existing retirement plans. One of the major changes enacted by the Secure Act was to change the age that requires a retirement account owner to take a Rmd, or required minimum distribution. The old laws required distributions to start in the year you turn 70 and a half. The new law changed this to begin by April 1st in the year after you reach 72. Another major change enacted by Secure Act was to remove the age limit that did not allow those with earned income to make a traditional IRA contribution after age 70 and a half. Now you can make up to $7,000 contributions, a $6,000 regular contribution plus $1,000 extra contribution for being over 50 years old, to a traditional IRA at any age over 70 and a half, only if you have that much or more in earned income. However, if you do make this contribution over age 70 and a half, it reduces how much you can use from your retirement funds in a qualified charitable distribution. If you're considering this new opportunity, please communicate with us and your tax preparer for further details. While not part of the Secure Act, qualified charitable distributions are a strategy for retirement savers. This provision allows retirement savers to directly distribute up to $100,000 to eligible charities straight from their retirement accounts after age 70 and a half and not pay tax on this distribution. One idea that experts suggest is if you're charitably inclined, consider using part or all of your required minimum distribution, or Rmd, for a qualified charitable distribution, or QCD. Like many of the other strategies we are discussing today, this is one you should see us about if you're interested in evaluating your situation. Another major change enacted by the Secure Act was to create some new 529 plan rules. They include the ability to use up to $10,000 in your lifetime for qualified student loan repayments. Another major change enacted by the Secure Act was to remove the 10% retirement account penalty for up to $5,000 of retirement funds withdrawal if you are under the age 59 and a half. This is only for expenses incurred within a year of this childbirth or adoption. There are abilities to repay this into the plan, so if this is a strategy you would consider, see us and your tax advisor for details. The Secure Act made sweeping changes to how inheritors need to take funds from a retirement account after the death of the owner. The new Secure Act created a 10-year rule that basically requires all inherited IRAs, Roth IRAs, and qualified plans to be distributed within 10 years of death. It does make exemptions for certain types of beneficiaries. These are surviving spouses, the employee's children under the age of majority, not the grandchildren or other children, disabled individuals, chronically ill individuals, and non-spouse beneficiaries who are less than 10 years younger than the IRA owner, for example, a sibling 7 years younger. Under the old rules, IRA owners could leave their IRAs to heirs who could stretch their withdrawals over the inheritor's lifespan. This new rule, or 10-year rule, says that there is no requirement for annual distributions. The account just has to be fully distributed by the end of the 10th year, following the year the account owner dies. Your objective is still to reduce your taxes and take advantage of tax deferral as long as possible. There's a warning though. For some beneficiaries, the 5-year rule may apply, so talk with a tax advisor to evaluate your situation. Also, please remember that the plan documents of a company retirement plan can override this 10-year rule. This changes many of the planning strategies that experts recommended. According to industry experts like Bob Keebler, CPA, MST, AEP, of Keebler & Associates, one of the old rule's best practices was to, whenever possible, leave all of your retirement assets to your spouse, who, upon death, would leave them in an inherited IRA to heirs, who then had the option to stretch their withdrawals over their lifetime. This enabled a potentially long period of tax deferral and, hopefully, asset growth. If you now leave your retirement funds to your spouse, they still must take distributions over their lifetime. As this example shows, spouse dies 8 years later, then that person leaves it to the beneficiaries who are subject to this new 10-year rule. Industry experts like Bob Keebler are now sharing that the potential new best practice is to review a plan that should consider, if appropriate, leaving some of your retirement assets to your spouse who, upon death, would leave those assets in an inherited IRA to heirs, and also leaving some directly in an inherited IRA to your children or others. This could potentially create a spread of tax liability over more brackets and more years. Back to the example. When your spouse dies 8 years later, during their 8 years of life, your spouse and beneficiaries, who have 10 years to take out this inheritance, could be taking distributions, and then after the spouse dies, their beneficiaries are subject to the new 10-year rule on the final amounts left. This strategy would potentially, if it makes sense tax-wise, spread the tax burden over 18 years, not 10. The new 10-year rule reminds us that a proactive approach could potentially reap rewards. To maximize your situation under the new 10-year rule, you may want to consider Roth conversions and possibly spreading distributions over many years and lower brackets. Unlike distributions from regular IRAs, Roth IRA qualified distributions are not taxed. A critical area to review because of the Secure Act is what we refer to as overall family tax bracket management. Logically speaking, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions in their tax bracket rather than you in yours. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take distributions in your bracket. Convert these accounts to Roth IRAs and leave them in an account that still has to be taken out in 10 years, but can grow tax-free. The first step is to review your marginal tax rate and your beneficiaries' marginal tax rates each year. Let's review tax rates for a minute. Here are the current tax rates for married filing jointly and single filers. Married filing jointly has lower rates on many amounts. Something that you need to remember is that even if no changes are made to tax rates, then in 2026 the law says we go back to the older higher rates, so when making your plan, we need to remember that. Let me say that again. The tax laws call for a sunset in 2026. So the law says we go back to the older, higher rates automatically in 2026. As this arrow shows, for some people, that means a large withdrawal could mean what is today taxed at 24% could be taxed in 2026 at 33%, which is obviously a much higher rate. How can you make the mathematics of IRA conversions work for you? Your personal critical decision factors include your tax rate differential, tax in year conversion versus tax rate in withdrawal years, use of outside funds to pay the income tax liability, need for IRA funds to meet annual living expenses, Rmd considerations. Remember, these begin at age 72. If you convert to a Roth IRA, Roth IRAs do not have RMDs. Time horizon. How old are you and how long can you defer taxes? Estate tax considerations, and the 10-year rule. These are not easy choices, and we can help you review your personal situation. Many experts like Bob Keebler are suggesting that a sweet spot for considering using partial Roth conversions are for those who can currently fill up as high as the full 24% tax bracket, and after the sunset go as high as filling up the 28% bracket. Again, we can help you review your situation. Some other reasons to consider Roth conversions, if appropriate, include tax brackets could rise in future years, and your account value might be down from a drop in the market. Some benefits from Roth IRA conversions include they could lower overall taxable income long term. Roth IRAs enjoy tax-free compounding. Roth IRAs also have no RMDs at age 72. Roth IRAs allow tax-free withdrawals for beneficiaries. As part of our family tax bracket management strategy, we also want to confirm your beneficiaries and contingent beneficiaries. To maximize your options for transferring wealth, we should check your primary beneficiaries and your contingent beneficiaries. Whatever strategy we end up evaluating, we can help coordinate your opportunities with your tax preparer. As a recap, what are some key takeaways? The Secure Act has permanently changed retirement. Your situation and the new 10-year rule needs to be reviewed. Our goal is to help clients understand their choices. Your health is our highest priority. Lastly, continue to focus on your personal goals and call us with any of your concerns. Now, what can you expect from us? You can expect regular communications, more frequent discussions, and you can expect that we are continuously reviewing economic, tax, estate, and investment issues for our clients. Thank you for your time today. Remember, your health and well-being is our highest priority. We appreciate the opportunity to assist you with your financial needs. We would like to help others in 2021. In fact, we would be honored if you could share some names of friends to send this video or to add to our mailing list so they can benefit from our information. Thank you again for your time today, and remember, a proactive approach can many times lead to better results than a reactive one.